principal international tax office, and I sit in the Spokane office, but my focus is really on pass-through entities, on partnerships and S corporations. And then I'm joined by my co-panelist today, Andrea Mao, and she'll get a chance to introduce herself, I think, when she does her section. So we're covering kind of 10 different hot topics that businesses are facing with this new filing season and then with tax reform. So I think with that, we will start it off, and this is our agenda for the day. And the first agenda item today is very on point because we have brand new guidance that came out on Friday. So just as a recap, for those not familiar with Section 199A, 199A is the analog for the corporate rate tax cut that corporations had the rate cut from a height of 35% down to 25%, or down to 21%. And the question was, well, what do you do for every business in America that's not organized as a C corporation? So that's partnerships, S corporations, estates, trusts, and so forth. All the everyone listening to this webinar, anyone that gets a K1, you're not affected by the corporate rate cut. So what Congress gave us was new Section 199A that provides a 20% deduction if you have qualified business income. Now there's a whole bunch of stuff to consider out there. It sounds simple on the purpose. Having looks like someone's having issues there with the audio. I think Amy responded, but there's a whole bunch of questions out there on how do you compute the deduction, and just know that there's various limitations to consider depending on your taxable income amount. If you're under what we call the threshold amounts, which is $315,000 for married filing joint, and then $157,000 for 500 for single filers, you may not have to worry about those limiting factors. If you're over those amounts, just because you have QBI doesn't mean you automatically get the deduction. You have to consider, have you paid enough wages as part of it? And if you don't have wages, there's a separate test equal to the unadjusted basis in your property, a percent of it. We won't go into those details today. There are things out there. We have insights that we've published, and we've done other webinars that dive into details with that. But today we thought we'd do kind of a quick hitter, things to consider for 199A. Now, and the biggest thing, and this is what just came out on Friday, was proposed regulations were issued back in August on 199A. And what they didn't tell us to do is, or what they didn't help us with, was rental income. So for most trades or businesses out there, it's a pretty easy determination to figure out whether you have qualified business income and whether you're eligible for the 20% deduction. Rental real estate is a unique issue, and it's not unique to 199A. It's been a problem for the last 60 or 70 years. And the basic problem is this: how do you know whether you have a rental trade or business? So if you get a K1 with rental income, or if you own a building, or if you own several buildings and there's rental income from that, how do you know if it's a trade or business? And it matters for 199A because if it rises to the level of a trade or business, then you're eligible for the 20% deduction. If it doesn't rise to the level of a trade or business, then you are not eligible for the deduction. So people were pushing the IRS very hard for some additional guidance specific to rental income. And fortunately, they came through, and whether it's helpful or not, we'll see. But they issued some final regulations on Friday, but then they also issued a notice, and the notice is basically, the IRS said in the notice that they intend to issue a revenue procedure. And a revenue procedure is just a ruling from the IRS, for lack of a better word, that says if you meet certain requirements, the IRS will respect your characterization of something. And in this particular case, this proposed revenue procedure provided a safe harbor that says that if you meet certain requirements, your rental real estate business, the income from that, will be treated as qualified business income and eligible for the deduction. Now, a couple of key points here: just because you don't meet the safe harbor doesn't mean that you flunk 199A. It just means you're outside the safe harbor, and you would just look to other guidance out there for whether you have rental income. So as we go through these requirements, if you don't meet any of these requirements in the RevPROC, that doesn't mean that you are out of luck. And then the other important point was the IRS said that if you're going to treat it as trade or business income for 199A purposes, that you should also treat it as trade or business income for all other parts of the code. And so this could, for instance, include all different filing requirements, that if you're making payments to people from this real estate business, that you should be issuing Form 1099s, just like any other business would be required to do. So I think the IRS was anticipating that there may be many quote unquote real estate trades or businesses that perhaps don't operate like other trades or businesses in terms of filing requirements. The IRS is saying that you need to, if you're going to treat it as 199A income, as qualified business income, that you also need to be consistent for all other filing requirements. So three requirements to meet this safe harbor. The first requirement is that you need to spend 250 hours a year with respect to the real estate enterprise. And this doesn't just have to be owner services, employee services can qualify, third-party contracting service could qualify. So if you hire a property maintenance company to manage your property or to manage your building, that could certainly qualify. Now, they also gave us some examples of things that don't qualify, and this is in that second sub-bullet point. And reviewing financial statements, arranging financing, looking to make long-term capital improvements, traveling to and from the real estate. The IRS said those types of services don't qualify towards this 250-hour requirement, because the IRS said in its eyes that looks more like an investor versus operating a qualified trader business. So 250 hours in what the IRS considers the good category, which is kind of direct operation of the rental real estate. Then the IRS also said that you need to keep contemporaneous records. So it's not enough at the end of the year just to kind of do addition in your head and say, oh, I think I'm close to 250 and I've satisfied the safe harbor. That you're going to want contemporaneous logs or emails or something that can show that when you sit at the end of the year and add it all up, that you can point to it and say, this specifically shows that I spent this amount of time. The second requirement is that you maintain separate books and records for the rental trader business, and you also have a separate bank account. And then the third requirement, which is maybe difficult for some people, is that it cannot be a triple net lease. So the IRS there's guidance out there from the IRS that says they view a triple net lease as being more in the vein of an investment, because the landlord doesn't really have any risk. Triple net lease is where the tenant is paying for maintenance, is paying for repairs, is paying for insurance, and is paying the property taxes. And the IRS says, well, we view that maybe more as an investment activity on the part of the landlord, not a trader business. So you can't have a triple net lease and be under this safe harbor. Now, does that mean all triple net leases don't qualify for 199A? Not necessarily. There may be facts and circumstances that one can envision where maybe there's scale, maybe there's more commercial aspects to a particular real estate trader business, and the triple net lease could qualify, but you certainly don't qualify under the safe harbor if you have a triple net lease. A couple other things, just in talking with the rental income, if you have self-rentals, automatically qualify for 199A. So self-rentals are where you own your operations, and then you also own the real estate, typically in a different entity. Maybe you're doing this for state law purposes, for liability protection purposes, and the business operations use the real estate. The rental income paid from the operations company to the real estate entity is treated as good 199A income for purposes of the 20% deduction. The real estate entity on its own doesn't have to qualify as a trader business. Now, just keep in mind, if your operations, if that's a doctor practice on the right side, then because doctors ordinarily don't qualify for the 20% deduction, that's going to taint your rental income on the other side. So it could cut both ways. Something also to pay attention to, in the beginning slide, I mentioned qualified business income is eligible for the 20% deduction. There's something called specified service trades or businesses, what I'll call SSTBs. They do not qualify ordinarily for the 20% deduction unless you have taxable income under the threshold amounts. And there's a whole list of service businesses that don't qualify. Think doctors, lawyers, accountants, people involved in the financial services industry. There's a whole list of 10 or 15 different industries that don't qualify for 199A. There's a very harsh rule that was in the proposed regulations issued in August, and then that were just finalized on Friday, that says if you have a single trader business and more than a de minimis amount of your gross receipts come from a service business, it taints everything. And if you're over 25 million, you can only have 5% of your gross revenue from a service business. If you're under 25 million, that's relaxed a little bit. It's anything over 10%, but it's the cliff effect, because you can get right up to the cliff. And if you're under 25 million, you can have 8%, 9%, 10% of your gross revenue. The moment you reach 11%, you're at the very bottom of the cliff and none of your income qualifies for 199A. So something to be aware of. Aggregation, there's no big changes in the final regulations that were issued on Friday, but the basic idea here is that you have businesses under common control, and that if there's certain relatedness between different businesses, you can aggregate them together for purposes of computing the 199A deduction. And this can help because you can combine wages amongst those different businesses for the limitations purposes. And it also just may make it easier for compliance purposes to put different businesses together and make one computation versus having to do separate computations for each separate trader business. You can now aggregate. The proposed regulations said that you could only aggregate at the individual level. These final regulations that came out on Friday tell us that you can either aggregate at the entity level. If you have a partnership that owns multiple businesses, that partnership can aggregate, or you can pass out the information to the individual owners and they can aggregate. Finally, there was a very harsh rule that was clarified in the final regulations, and it says basically partnerships and S corporations are going to have to separately list all of this important information out on their respective K1s, meaning that partnerships and S corporations are going to have to indicate whether their income is qualified business income or not. Also going to have to list out each owner's share of the wages paid or the unadjusted basis in property for purposes of computing the 199A deduction. And the final rules say if you fail to do this, if you're a partnership or an S corporation and you fail to indicate something's QBI, or you fail to include wages, the item that's omitted is presumed to be zero at the taxpayer level, meaning the taxpayer potentially will not be able to claim the deduction. And this is true even if you know all of the owners of the S corp have taxable income of only $100,000, so that you don't have to worry about any of the limitations. If you fail to state that there's QBI in the business, then those ultimate owners of the business cannot claim the deduction because it's presumed there's $0 of QBI. So very important that all partnerships, large and small, S corporations, partnerships, different businesses, if you fail to list any of this information on the K1, it's going to result in your owners having a $0 deduction. So moving on from 199A, this was a popular topic at the end of last year, and the basic idea, we call it choice of entity in the tax world. And choice of entity for us means choosing typically to be either a flow-through, which is an S corporation or partnership, or choosing to be a C corporation, which could be various state law entities, but electing to be treated as a C corporation for tax purposes. And the basic difference is partnerships and S corporations do not pay an entity level tax. They pass out their income and they pass out their losses to their owners, and the owners pay tax at the individual level. Versus a C corporation, think Apple, think IBM, pays tax at the entity level. And then the C corporation, when it pays its earnings out to its shareholders, and these earnings typically are in the form of dividends, then the shareholders again pay tax on that money. The verbiage you often hear is that's the double layer of tax that a C corporation pays, versus partnerships and S corporations only have the single layer. So this graph shows here, since the mid-'80s, partnerships and S corporations have become the dominant form of doing business. And the reason why is just to avoid the double layer of tax paid by a C corporation. If you take into account the double layer of tax, C corporations traditionally were paying 10 points higher of a tax rate as compared to S corporations and partnerships. So it was almost, when I was in school, I heard my professor say that it's almost malpractice to put a client into a C corporation unless they're forced to do it. Publicly traded companies have to be C corporations. Sometimes certain large enterprises have to be C corporations, but otherwise, really the incentive was to be a partnership or an S corporation because to avoid the double layer of tax. So the question is now, with this new corporate tax rate that's been lowered to 21%, which should that encourage people to look back and say, well, maybe now I want to be a C corporation because the corporate rate cut's been cut by 14%, and maybe that's an incentive now to be a C corporation. Admittedly, I'm a partnership and an S corporation person, so sometimes I joke that I'm a bit biased against C corporations, but admittedly, it's a much closer call today than it was last year because of this corporate rate being cut. I still think in many cases, pass-through form is favored, so that if you're a partnership or an S corporation, you still may be better off from a tax perspective. And one of those is if you're eligible for 199A, that 20% deduction, likely you're going to want to remain in flow-through form. If you're not eligible for 199A, it's a very close call between going to a C corporation or remaining a pass-through entity. And one thing that could favor C corporation, this is on the bottom of the slide here, there's a provision that says if you have a qualified small business, it's code section 1202, you can sell the stock of that qualified small business. And if you meet a bunch of requirements, you can exclude the gain. That provision is only available to C corporation shareholders. You cannot use that provision if you're a partnership or an S corporation. So that could be one reason to think 1202. There's the couple of taxes that are particular to C corporations, called one's the personal holding company tax, one's the accumulated earnings tax. These have not mattered in a very long time because most people have not formed C corporations or converted to C corporations. But if you're thinking of forming a C corporation and either to shelter a bunch of investment income, or maybe you say that I'm going to form a C corporation, we're going to pay tax at the entity level, but we're going to retain all the cash to avoid the dividends tax paid out to shareholders. These two taxes are there to police that, and in certain circumstances they can result in kind of an excise tax or an additional tax. So just something to be aware of if you're meeting with your tax advisor on converting to a C corporation. There may be things to think about that no one's really thought about for the last 20 or 30 years. And then lastly here's some factors on the left that could favor becoming a C corporation, and then factors on the right that could favor becoming a pass-through entity or remaining a pass-through entity. If you're going to sell a business, oftentimes it's easier in flow-through form because you'll only pay a single layer of tax. And like in the partnership setting, for instance, the purchaser can get a step up in assets. But on the C corporation side, it's easier to carry NOLs forward at the entity level. If you have a long-term horizon, a C corporation may be more in favor because there's no sale that's imminent, and so maybe you're not so worried about having an attractive tax profile. 199A is certainly a differentiator. If you qualify for 199A, you likely are going to want to remain in flow-through form. And then, as I mentioned before, on 1202, if you're thinking of selling stock, then C corporation form, if you can qualify under 1202, potentially you can exclude all of the gain from tax under 1202. And you can't do that with a partnership or an S corporation. With that, I will turn it over to Andrea.
All right, thanks, Adam. So the next topic we're going to talk about is the small taxpayer safe harbors. You recall perhaps that one of the key selling points for tax reform was simplification. They're going to simplify the process of completing tax returns. And if you haven't already gathered from Adam's discussion today, that isn't entirely true across the board, but at least in this area it is. What they've done is they have expanded the group of taxpayers that are allowed to use the simplified accounting methods. They're allowed to use the cash method. They can account for their inventories as non-incidental materials and supplies. They can stop applying the uniform capitalization rules of 263A and the percentage of completion method for long-term contracts. Historically, to qualify for one of these safe harbors, you had to meet certain requirements both around your business activities. Manufacturers were often subject to more stringent tax accounting rules than resellers, and even the entity structure made a difference. C corporations were subject to a much lower threshold for using the cash method of accounting than were S corporations and certain partnerships. So this has broadened and leveled the playing field among the different entity types. and they boosted all of those safe harbors to $25 million. So as long as your average gross receipts are less than $25 million, you are eligible to take advantage of one or more of these accounting method changes. So the definition of a small taxpayer then becomes very important. There we go. And under the new rules, a small taxpayer is defined as a taxpayer that has average gross receipts of the prior 3 years less than $25 million. So for 2018 year, the 3 years we're going to be looking at are 2015, 16, and 17. So if you cross the threshold in 2018, technically you'll be required to move back to the more complicated methods starting in 2019, but you're still okay in 2018. One of the challenges, though, in applying this rule are the aggregation rules. Under the 448 regulations, you are required to aggregate or include the gross receipts of all entities that have greater than 50% common ownership. So if I happen to own 75% of 3 different businesses, I need to add together the gross receipts from all 3 of those businesses, and that average of all 3 of those numbers needs to be less than $25 million in order for me to qualify for this safe harbor. Additionally, in the interest expense limitation regs that we'll talk about later on, the IRS added an additional layer where I need to look through and include a pro rata portion of the gross receipts if I own an interest in a partnership or an S corporation. So if I own a 5% interest in a partnership, under those rules, I would be required to include 5% of that partnership's gross receipts in my income. We obviously, given the prior information reporting rules, may or may not have that information available. So it is going to be a challenge, I believe, for this year. Going forward, I think on the K1s, we will start seeing a gross receipts number come through so we can apply these tests a little bit more easily. But for the first year, I think this could very well be a challenge. And this applies to tax years beginning after 12/31/17. So if you are a fiscal year taxpayer, it's going to be your fiscal year that starts in 2018. We aren't going to be able to apply these to any tax years that started prior to 12/31/17. The IRS did give us some guidance in Revenue Procedure 2018-40. They gave us new automatic accounting method changes that we can file in order to adopt these small taxpayer safe harbors. And you'll see here that there are four different accounting method changes, and there's no requirement that you file all or none. You can choose from this list if you want to stop applying UNICAP but stay on the accrual method. You can do that. You'd file a change 234 but not the 233. So you can independently make a decision on each of the 4 safe harbors on whether they make sense for your business or not. The key requirements of these accounting method changes is that we will need to file a shortened Form 3115. The Form 3115 is the application for change in accounting method. The good news is we file those with the tax returns, whether the original or extended due dates, so we can get those put together anytime prior to when you file your return. And it also gives us audit protection for prior improper methods. So if I have been applying UNICAP in the past, but my method wasn't accurate, it wasn't what the IRS would say is permissible, by filing this change, I can close the door on the IRS's ability to audit me for those prior years, which is very valuable for some taxpayers. In the case of the long-term contract changes, those are implemented on what they call a cutoff basis, which means that our new method only applies to contracts entered after January 1 of 2018. We make no changes to any of the contracts that started prior to that. The other changes, we get a 481A or a catch-up adjustment, and that means that we get to cumulatively catch up our balance sheets as of 12/31/17 as though we had been using these new simplified methods in the past. And we're seeing already for some of the 3115s that have come in that there are some very sizable favorable adjustments coming in on those changes. So it's certainly a good opportunity to take some significant deductions in 2018. There's also, the IRS has lifted some of the restrictions on filing these changes for the next couple years. Typically, they don't like us making the same automatic accounting method change more than one time in 5 years. However, in the case of these changes, because we had a change in law, they are going to ease that restriction a bit and allow us to file automatic changes for these items for 2018, 19, or 20, which then raises, another interesting point. If we find out that this is going to generate a very large favorable adjustment, and you're already in a loss position for 2018, we don't have to file the change for 2018. We can move it into 2019 when the deduction may be more valuable to you for one reason or another. So we have some flexibility in how we take these into account to match your situation. And one other small note on the new 3115, the IRS has revised the Form 3115 effective for 2018. So we will need to double check to make sure you are using the proper version of the form. The prior version issued in 2015 may be acceptable for a few months here, but may not be acceptable once we get to extended return time. So keep that in mind if you're intending to extend your tax return. The next topic we're going to talk about a little bit is the bonus depreciation and immediate expensing. And so you can see here, part of tax reform was to increase the bonus eligible percentage from 50%, which was under prior law, to 100% for property that is acquired and placed in service after September 27 of 2017 and prior to December 31 of 2022. This means that if the property qualifies for bonus, we can deduct the entire cost of the property in the year that it is placed in service. And you'll see here they've already scheduled a phase down starting in 2023, if it lasts that long. So property eligible for bonus, there's generally 4 requirements. It has to meet the definition of qualified property. So usually that is property with a recovery period of 20 years or less. Software, it did expand the definition to include some theatrical and artistic production type expenses, but for the most part, it's going to be your tangible property with a recovery period of less than 20 years. One of the best, I think, expansions that this made was that historically only new property or original use property was eligible for bonus. Meaning if I went out and bought a brand new pickup truck, I could take bonus on it, but if I bought a used truck, I could not. They have lifted that requirement and do allow now the acquisition of used property to qualify for bonus in some situations. We need to, there are the requirements that we need to meet in that case is we need to make sure that you have not previously had a depreciable interest in that property. So that means that I can't buy something, sell it to Adam, and buy it back from Adam and somehow generate bonus depreciation because I used to have a depreciable interest in that property. But if I'm leasing property under a true lease where I don't have a depreciable interest in the property, and then at the end of the lease term I buy the property, that would be eligible for bonus depreciation. So you have to kind of look at the nature of the transactions to confirm whether the used property will qualify, but in a lot of situations I think it will. And then the third requirement is that it has to meet the placed in service date requirements from the prior slide. We have to look to whatever year it is that the property is placed in service to identify the proper percentage of bonus depreciation. And then the property has to be acquired after September 27 of 2017, which seems fairly straightforward, and it is in a lot of cases where you walk in and buy something on the same day, but where you acquire property under a contract. So I sign a contract with Adam that I'm going to buy some piece of equipment from him 6 months from now. If we had signed that contract prior to September 27, even if I got the property afterwards, I would not qualify for 100% bonus depreciation. That can also come into play where you're self-constructing an asset, or I'm building a building or a piece of equipment for use in my business. In those cases, I may have an acquisition date prior to September 27. So we need to watch those types of situations.
Hey, Andrea,
one of the
this is that someone asked a question. Someone said, does bonus depreciation apply to the AMT, to alternative minimum tax?
I believe it does. I think you slow down your depreciation recovery periods, but there's still bonus eligible assets, I believe.
I think that makes sense. Sorry, the question just popped up in the box.
Okay. The other thing, one of the bigger confusion points after tax reform is how to treat all these categories of improvement. So qualified improvement property was interior improvements to non-residential real property made after the building was placed in service. Under the old rules, so prior to tax reform, that property was eligible for 50% bonus, but had a 39-year recovery period. There's also qualified leasehold improvement, retail, and restaurant property. And if you could meet the requirements for those sections, you got a 15-year recovery and were bonus eligible at 50%. After tax reform, the intention of tax reform was to remove the leasehold improvement, retail, and restaurant property categories and consolidate all of them into qualified improvement property. So you'll see in the box on the far right there that anything placed in service after 12/31/17, there's no such thing as qualified leasehold improvement, retail, or restaurant property anymore. The only category of other property or improvement property that still exists is qualified improvement property. However, the IRS's intention in tax reform was to reduce the recovery period from 39 years to 15, which would allow bonus depreciation because it has a recovery period of less than 20. However, as it turned out, somebody actually forgot to put that sentence in the bill before they passed it, meaning that it is not included in the current tax code. And unfortunately, that leaves us in a position for property that is both acquired or property that is placed in service after 12/31/17 is going to have to be 39-year recovery property with no bonus. We are hoping that the IRS is going to, and actually Congress is going to go through and fix this and give us our 15-year recovery and bonus, but as of right now, we don't really have a position to do that on our returns. So stay tuned. It is part of the technical correction bill that has been proposed, but hasn't necessarily made a lot of headway yet in terms of getting passed. And obviously right now, not a lot is going on in the government at all. So we don't really know when or how we'll be getting that guidance. The other provision, the immediate expensing provision that was enhanced under tax reform is 179. So 179 is generally applicable to tangible property and then certain qualified real estate property, and it allows us to deduct up to $1 million of property that's placed in service during the year. However, if we place in service more than $2.5 million, we need to reduce our $1 million deduction dollar for dollar for every dollar over $2.5 million. So effectively, if I put $3.5 million of property in service, I'm not going to be eligible for 179. They also expanded their indexed the amounts for deducting the cost of sport utility vehicles is now up to $25,000, which is a nice change. The 179, as I said, it generally applies to your tangible personal property, but it also comes into play on certain real property. And these are the categories of real property assets that are eligible for 179. So qualified improvement property, that's the same categories was on the prior slide for bonus. So it's interior non-structural improvements to non-residential real estate, roofs, certain components of HVAC, fire protection, security systems, and we can also now take 179 on assets used in the lodging industry. So the nice thing is, so qualified improvement property, as I mentioned on the last slide, we don't have our 15-year recovery period for that, so we don't get bonus on that right now, but including that in 179 is not impacted at all. So we're still eligible to take a 179 deduction on that. And the other category of assets here to watch for in 179, because I get a lot of questions, okay, does it really matter? I'm getting a full deduction under 179 or bonus depreciation right now in 2018, so why should I care? There are a few situations in which you could care. So property, there are certain categories of property that are eligible for 179 but not bonus. As I said, the only real bonus eligible property related to a building is going to be qualified improvement property, which has to be interior and non-structural. Well, from this prior slide, roofs, HVACs, fire protection systems, a lot of those are not interior to the building, meaning that they can never qualify for bonus depreciation. So if we want to fully expense them, we need to use section 179. The dollar limitations are also important. 179 is going to run out quite quickly if you have a lot of assets that you're acquiring and placing in service in any given year. There are also some taxpayers that are not eligible for 179. There were no changes to those rules. So our non-corporate lessors, estates and trusts are not going to be eligible to take the 179 deduction, so they need to look for the bonus rules. And then there are some limitations on bonus depreciation that we'll talk about later on when we get down to our interest expense limit discussion. Now I think I'm going to turn it back to Adam to talk about opportunity zones.
Excellent. Thank you. So opportunity zones, so much in the news, and this was a provision that was passed as part of tax reform at the end of 2017. And the basic idea was to incentivize investments into quote unquote low income or disadvantaged areas. And the first part of this was to figure out where the zones should be. And last year, in the spring of last year, state and local governments working with the Treasury Department figured out where these areas should be. And I actually think the process was more along the lines of local governments petitioning their governor for where they want the investment zones to be, the governor picking and choosing what areas would be nominated to the Treasury Department, and then the Treasury Department in DC working with those local governments to figure out what tracks should be designated, because there was a limit to the total amount that could be designated. But effective for the 2018 tax year, and the basic gist is you must have eligible capital gain. If you sell a capital asset, if you sell publicly traded stock, you can choose to roll that gain into an investment, into an opportunity zone, and you can defer that gain. That's the basic idea. Now, we have some guidance out there in October of 18. There was proposed regulations issued, but it only answered some of our questions, and there are many more unanswered questions than there are answered questions at this point. But I thought we'll go through the basics here, and then we have a quick example, and maybe it can clarify some of the misconceptions out there. So the first thing, like I said, you must have eligible capital gain. And you actually cannot take that gain and necessarily just buy property directly in an opportunity zone. Instead, what the statute says you must do is you must invest into a fund, and then the fund takes that capital and makes an investment into an opportunity zone. And you have 180 days to make that investment. So if you sell your publicly traded stock or you sell your capital asset, you have 180 days to roll that gain over into the fund. You don't have to roll all of the gain, and you don't have to roll the principal. So it's more generous than people familiar with Section 1031 exchanges. This is a more generous provision because you can choose to only reinvest a portion of your capital gains. You can keep your principal, so you don't have to match gross proceeds on sale to gross proceeds invested. You can pick and choose whatever amount you want to invest into it. The fund itself that you're investing into could be a partnership or corporation for tax purposes. We expect in most cases for it to be a partnership. And then the fund must make the investment into the opportunity zone, and there's a requirement that 90% of the fund's assets must be invested into the opportunity zone. So the fund can't just sit on the cash or make investments into the stock market with the cash. Congress wants that cash put into use, hopefully doing good in the relevant opportunity zones. The tax benefits involved from an investor's perspective: first, you're going to get deferrals. So that means you're not paying tax on the capital gains. Secondly, there's basis step-ups if you hold your interest for a long enough period of time. And then if you hold your interest for 10 years, there's the potential to exclude all of the post-investment appreciation on your investment. So I think we have a quick, this is kind of an example here to show how it works. But if you invest $100,000 of qualified capital gain into a fund in 2019, so you're a taxpayer, you sell stock, you bought the stock for 100 grand and you sell it for 200 grand. So you have 100 grand of gain. You could keep the 100 grand of return of the original 100 grand, you could keep that cash in your pocket. 100 grand of qualified capital gain, you choose to roll it into a fund in 2019. So the first step, 2019, you don't pay tax on that 100 grand. Now remember, you've invested it into a fund. The first tax benefit is if you hold your interest in the fund for 5 years, you get a 10% step up in the basis of the fund. So if it's 100 grand, you get $10,000 of tax basis. Because remember, you've rolled over gain that you didn't pay tax on, which means you have $0 of tax basis in 2019. You have $10,000 of tax basis in 2024. If you hold it for an additional 2 years, you get an additional $5,000 step up. So if you hold it for 7 years, in our example here, you'd get a $15,000 step up. Now the kicker is, in 2026, you have to recognize the remaining portion of your deferred gain. Whether or not you sell your fund interest, in fact, you probably won't sell your fund interest, but the gain you deferred in 2019, you have to pay tax on that in 2026. So in my example here, we've held our interest for 7 years. We've had a $15,000 step up. So we pay tax on $85,000 of the deferred gain. So we had 100 grand of gain. We only pay tax on 85 grand of it. In year 10, if we sell our interest in the fund in year 10, and let's just say it's doubled in value, all of the post-investment appreciation is excluded. So that's the real juice in the statute, is the potential to exclude all of the tax gain when you exit the investment. Now you notice here that envisions a 10-year hold. So it's a long-term hold. If you're looking to make this investment, it's a long-term play. If you sell in the interim, you're going to lose that tax benefit. And one other point I'd make on this is, well, 2 points. One, I would say there's many more complications than we can really do justice to it today. So if you're seriously thinking about making an investment or setting up a fund, come talk to us offline or talk to your local Eide Bailly tax professional. There's many other things to consider here that are really outside the scope of today's presentation. And then two, the most common question we are getting with opportunity zones is, you own property or a business and you look on a map and you notice that your property or your business is located in an opportunity zone. What is the opportunity? And truthfully, there isn't that much opportunity for you. I mean, it's not magic. You can't just sell. If you own an existing building and you sell it and that building's in an opportunity zone, you still have to pay tax on that. Now, you could choose to sell the building and roll over the gain into a fund if you wanted, but you can't just walk away with your cash. Or, well, I should say you can walk away with your cash, but you would pay tax on it. So that is probably one of the largest misconceptions, is that it doesn't mean anything necessarily just to own a piece of property or own a business in an opportunity zone. Although maybe it'll make that property or that business more attractive to an investor, because if a fund buys it from you, then potentially that fund can qualify for the opportunity zone benefits. But that doesn't necessarily provide any immediate tax benefit to the taxpayer. So that takes us to our second polling question. And it's true, false, so we're keeping it simple. It says, yeah, with opportunity zone credits, eligible capital gains, it's not really it's a credit, not a credit, it's a tax benefit. So we'll clarify that. But eligible capital gains must be reinvested into a qualified opportunity fund within 180 days. True or false? Excellent. People were paying attention. So the majority of people, 90% of the people are saying that's true, that's right. You generally have 180 days to roll that gain over into the fund. 1031 exchanges, we kind of, this will be brief, this presentation here. 1031 exchanges, the basic idea is traditionally 1031 is provided deferral if you sell property and then within a period of time you purchase like-kind property, you can defer gain on that sale. So if you sell a building for $1 million and you find replacement property within 180 days and you purchase that replacement property, you can defer the gain on the sale. Very common, even if you're not a tax technical person, you've probably heard of a 1031 exchange. If you've ever wondered where the word 1031 came from, it's a code section in the code. Sometimes people know 1031 in the abstract, maybe don't know what it refers to. It's a code section. So this has been around forever. I referenced it in the previous slides there with opportunity zones. Opportunity zones are a little more generous because 1031 exchanges, there's requirements to match value for value, that if what you sell, you have to match gross value to what you purchase. You don't have to do that for an opportunity zone. But the big change to 1031 exchanges, 1031 still exists. There was talk originally about doing away with Section 1031 in its entirety. But for sales after 2017, for 2018, 1031 benefits are limited to real estate, to real property. So you have personal property. If you're selling a business truck or a business car, in previous years, you could use 1031 to defer the gain if you bought replacement property. Now that doesn't work. It's only if you have real property. So this could affect businesses that were typically exchanging quote unquote personal property, non-real property, and deferring gain. Maybe there's less of an option there now to defer the gain, But the one thing I'd point out, if this seems concerning, to piggyback what Andrea was pointing out there with bonus depreciation now being eligible for new and used property, you may still be able to avoid taxable income, because if you can claim bonus depreciation on the new property you bought, you may come to the same place. So just because 1031's gone doesn't necessarily mean you're out of luck. You should sit and talk with your local tax professional, and then maybe if you use bonus depreciation, maybe you can end up in the same spot. And I'll turn it over to Andrea.
All right, thanks, Adam. Let's see, so revenue recognition, we have a bit of a collision course going on right now. So ASC 606 are the new financial reporting standards for revenue recognition. And section 451B is a section of the Internal Revenue Code that was implemented in connection with tax reform, and it requires us to conform to our book accounting treatment under certain circumstances. And so ASC 606 was effective for public companies for basically the 2018 calendar year. 451B is effective for all tax years beginning after January 1 of 18. And then for private companies, ASC 606 is implemented or is required to be implemented during the 2019 calendar year. But we have the same implementation date for 451B, meaning that we'll have those rules applicable to us in 18, but the ASC 606 rules applicable in 2019. Generally speaking, the intention of ASC 606 was to replace a lot of the industry-specific, transaction-specific revenue recognition rules with this overall 5-step principles-based process. And so these rules are generally applicable to almost all taxpayers that have contracts with customers. And where we think we're going to see the most impact of these rules are those clients who have what they call multi-deliverable arrangements. So I'm selling a good that's bundled with a long-term warranty service contract, or I'm selling a cell phone with a multi-year data plan attached to it. Those are the type of situations where we think these are going to come into play, because going through this 5-step process, the second step, they're identifying the performance obligations. If I determine that I have more than one performance obligation, I have to provide a good and I have to provide a separate service, then that's going to require me to allocate my price to those things and recognize those components of the transaction over different periods of time, because I'm going to be earning those in different manners. Tax reform. So there were two adjustments to section 451 that I think are going to be important for taxpayers. The first one, 451B, means that I cannot defer revenue for tax purposes later than I'm recognizing it for book purposes. So if book is telling me I have to pick up $50 of revenue, I can't pick up $45 now and $5 next year. I'm required to follow book. There are expected to be some exceptions to this rule for what they call special methods of accounting. However, they have not exactly told us yet what they mean by special methods of accounting. So for right now, what we're kind of having taxpayers or clients do is look through their book tax differences and see if you have any situations where you have a favorable book tax difference for revenue, i.e. we're recognizing revenue at some time for tax purposes after the date we're doing so for book purposes, because those may need to be adjusted under these new rules. And then 451C codifies the rules around advanced payments. Advanced payments are situations where I collect cash up front for goods and services to be provided in the future. So maybe I collect all the cash up front for a 3-year software revenues, software license agreement. Under the current advanced payment rules, there were several different methodologies we could use to try to defer that income to recognize it as we're providing the services. But 451C is largely going to remove those and leave us with a 1-year deferral, meaning that I'll recognize to the extent that I recognize for book purposes in the year I get the cash, and everything else comes in the following year for tax purposes, regardless of what happens for book purposes. There are some nuances in this rule and whether taxpayers that don't have an audited financial statement can take advantage of them and what types of payments are eligible for this method. Again, we're still waiting for a little bit of guidance there, but if you do have a business where you're collecting a lot of cash up front and providing goods or services later, you'll want to keep an eye out for these rules because they will potentially impact when you recognize that revenue for tax purposes. And then we've kind of referenced some of the new 163J. These are the new interest expense limitation rules. And after tax reform, now all businesses, regardless of entity type, are limited to deduct this interest expense equal to the sum of three numbers. Business interest income, 30% of your adjusted taxable income, and floor plan financing. Adjusted taxable income is basically intended to be an EBIT type number, adding back interest and taxes. But for the next few years through the end of 2021, it's actually an EBITDA number, meaning that in addition to interest and taxes, I can also add back my depreciation and amortization. Also, my 199A deduction, if I'm eligible for that, is ignored, so I get to add that back. But there's a very important exception to the depreciation add back rules that came as a bit of a surprise to a lot of people in the 163J proposed regs. If you are including any depreciation expense in your cost of goods sold, which we typically see for manufacturers, miners, some resellers, to the extent that your depreciation or amortization is going through your cost of goods sold, you cannot add it back, meaning that your adjusted taxable income number is very likely going to be lower than a business that has depreciation not going through their cost of goods sold account. So if you do have a lot of your depreciation in your inventory calculation, you'll want to watch out for these rules because you're more likely to be subject to them earlier than some of your counterparts. These are just kind of a summary of the entity-specific rules. For corporations, it's all at the entity level or at the consolidated group level. The S corporation rules, the limitation is applied first at the S corp level, and then shareholders have a separate 163J calculation for their activities outside of the S corporation. Probably the ugliest rules are the partnership rules. There's an 11-step allocation process to allocate interest expense and excess items between partners and partnerships. That's good luck, I guess is all I have to say for that. It is certainly going to be a challenging calculation for some partnerships. Which leads us to our exceptions. To the extent possible, we've seen clients try to qualify for these exceptions. First, small taxpayers. This is the same small taxpayer standard as the accounting method changes we discussed before. So as taxpayers with average gross receipts less than 25 million don't need to worry about these rules at all. Real property trades or businesses are eligible to elect out of the interest expense limits, and what that does is it requires them to depreciate some of their assets using the alternative depreciation system to extend out some of those recovery periods, but they still get to keep all of their interest expense. Farming businesses are similar. They can choose to be exempt from interest expense in exchange for slowing down some of their depreciation. And then regulated public utilities are also exempt from these rules. That is not optional. They are exempt. And that takes us to our third polling question, true or false? Interest deductions for every business, regardless of entity form, would be limited to the sum of business interest income, 30% of adjusted taxable income, and floor plan financing. 70% true, 30% false. And then I'll turn it back over to Adam here for our last few minutes to go through the overall business loss limit rules.
Thank you, Andrea. I always talk about the good with the bad in terms of tax reform. That the good is that rates are cut and people are perhaps paying less tax, but to some extent they had to try to figure out how to pay for it. One example of that was 163J, they being Congress. The other example of trying to pay for it is there's a new code section 461L, and it limits overall business losses to $500,000 for married filers and single filers $250,000. So a quick example of that, in a couple of years ago, if you had $1 million loss, you could offset that against all of your income, whether your income was business income or whether it was investment income. That loss could go against that. Now you can only take $500,000 of it. Now it's not all bad if it's disallowed. Part of it becomes part of your net operating loss in the next year. We're short of time, so I think the big question is, what is business income? And the question is whether W-2 wages count as business income. from a taxpayer's perspective, you're sure hoping W-2 wages count, that when you're taking your overall business loss, you can net it against wages first before figuring out whether you're limited or not. Now, some people say, well, wages shouldn't be part of it. And we've had some inconsistent explanations. The IRS put out a form last year, late last year, that seemed to indicate W-2 wages are business income, taxpayer friendly. But we recently had a report from the Joint Committee on Taxation that said maybe wages are not business income. But when Andrea brought up technical corrections, that may be what's needed to make wages not business income. So if you have this issue, sit down and talk with your tax professional, figure out, can you come to a position where, what are you doing with wages? The last minute, Andrea, I'll turn it over to you for meals and entertainment.
Right. So very quickly, also as a sort of take the good with the bad provision, the tax reform is going to limit our ability going forward to deduct meals and entertainment. Entertainment in general is going to be non-deductible under all circumstances. Meals will still be 50% deductible for certain business activities. There's 100% deductibility for holiday parties and other employee morale type events, but for the most part, a lot of the employer deductions are going away currently or will be phased down after 2025. There are two pieces of guidance that we've received thus far, both notices on this. The first one being 2018-76 that allows the deductibility of meals even if they're incurred in connection with entertainment. So for example, you take your client to an NFL football game. Well, the football tickets are going to be non-deductible entertainment, but to the extent that you separately pay for food, you're buying food at the concession stand or you're getting separately charged for the food component, even though it's consumed at the entertainment event, is still eligible for 50% deduction. And then 2018-99 talks about the non-deductible parking expenses and how those rules might apply in a situation where you're providing parking lots, ramps, garages for your employees, how those costs are figured out and determined the extent to which they are non-deductible, which I think may end up impacting more people than they had originally anticipated. So that's definitely something worth, I think, taking a look at. Feel free to reach out to either Adam or I. I believe our contact information was on the beginning slide and is here also at the end. If you have any further questions, we'd be happy to help.
Yeah, and we have webinars too. If you look on the iBailey website, we have insights and webinars that have covered a lot of these topics today, but in a more in-depth fashion. So encourage you to look there too.
Awesome. Well, there are no questions at this time. So if any of our participants do have questions, please reach out directly to Adam or Andrea and they'll help you. Thank you, Adam. Thank you, Andrea.
Yep, thank you.